Welcome to First Wednesdays. First Wednesdays is, of course, presented by the Rainier Institute for Entrepreneurship and Innovation. We are featuring the Entrepreneur Hall of Fame. We have Hall of Famer David Brain here today. We are also working in conjunction with the Bloch Alumni Association, Bloch MBA Speaker Series, and Bloch Executive MBA. First Wednesday is designed to bring together students with members of the Kansas City community. So take advantage of this opportunity. We're going to have food and drinks afterwards outside. Community members, feel free to talk to the students. Students, feel free to talk to community members. I don't think anyone bites here, so feel free to mingle and meet some new people. Before we get going, I should probably get my slides going. All right. So first of all, a few announcements. Like I said, food outside. Feel free to grab some and hang out for a little while. Also got a couple of very cool events to tell you about. First of all, our Career Accelerator. So over the years, we have a lot of companies come to us and say, we're looking for entrepreneurial students. We're looking for talented young people to join our team. Who can you connect us with? At the same time, we have a number of students that come to us and say, I'd love to work for a startup. I'd love to work for an entrepreneurial company. I just don't know where to find these companies. If you want to find a startup or small business, ironically enough, they're either small or they're just starting up. So it's sort of hard to find them at times. So we're dealing with these two dual needs. With our Career Accelerator, we're inviting in employers of entrepreneurial companies, of startups, of small businesses, and inviting students from all around campus. So February 26th, come join us, whether you're an employer, whether you're a student. Employers, come meet the great students we have here, build your pipeline of students for the future, fill internships, fill jobs. Students, if you're a business student, great. If not, even better. We're inviting people from all over campus to join us. We really want to show off the great students we have at UMKC. Next, I want to tell you about Summer Scholars. So this is an amazing opportunity that our very generous funders have allowed us to offer. Summer Scholars is an 8-day intensive entrepreneurship course. It's free to those that join. So we have scholarships available that cover the tuition and fees. We pay for lunch, we pay for all sorts of stuff. So 10 a.m. to 3 p.m. for 8 days, June 1st to June 10th. It's a great opportunity. We're looking for incoming freshmen and freshmen going into their sophomore year. So early stage college students, if you know of anyone, if you're interested, check out the website. Both of these programs, I've got some flyers. There's a bunch of flyers on the table. If you don't have one, there should be some on the tables outside. Take advantage of this. This is a very unique opportunity. Not very often do you get a free course, right? You tend to pay quite a bit for the courses. But this is a unique opportunity to get an entire 3-credit-hour course done in 8 days over the summer, and hopefully have a whole lot of fun. This course is taught by me and Dr. Tony Mendez. I don't know if he's made it down here yet, but the two of us teach it. Hopefully it's a lot of fun. Last year we started the program and it went fantastically well. So if you're interested, come talk to me afterwards, visit the website. There is an application process. And it's a rolling acceptance, so the sooner you get them in, the better. So check that out. At this point, I would like to bring up our director of the Rainier Institute for Entrepreneurship and Innovation, Dr. Jeff Hornsby.
Thanks, Ben. And there's a sign up here on the front row that says reserved, and that means it's reserved for students too. So as people come in, please direct them down here to have a seat. I do want to also mention that we are partnering with the Lewis White Real Estate Center for this event as well. So just to mention that, they're part of the Rainier Institute and what we do here at the Bloch School. Again, my name is Jeff Hornsby. I'm the director of the Rainier Institute and the department chair for the Department of Global Entrepreneurship and Innovation. at the Bloch School of Management. And I'm very excited to welcome all of you to our first edition of First Wednesdays for Spring Semester 2016. Throughout the semester, we're going to be presenting inaugural inductees of our Entrepreneurship Hall of Fame. And as Ben said, we have David Brain today, we have Bob Rainier in March, and Lamar Hunt in April. So some great speakers, great events. And so just put those on your calendar. You can count on it. The first Wednesday of March and April, 5 p.m., this room. We're real proud of our Entrepreneur Hall of Fame at the Bloch School, and we believe the tagline says it all. The Hall of Fame is a place where we honor bold ideas and inspire bright futures. It's inspiring events like this one where students, alumni, and community members come together to honor Kansas City's top entrepreneurs that bring the Hall of Fame to life. If you hadn't had a chance to view the Hall of Fame and its interactive exhibits, please be sure to do so after our event tonight. It's right over here. Kicking off the spring's First Wednesday series this evening is David Brain, founder of EPR Properties. David is a Kansas City native and has been a strong advocate for the Bloch School's entrepreneurship programs, having served as a mentor in the E-Scholar program and a judge in the Rainier Venture Creation Challenge. Additionally, David serves on the advisory board for the Lewis White Real Estate Center and has been a guest lecturer in several Bloch classes. In 2013, he was named the Regional Entrepreneur of the Year by the Rainier Institute during the Entrepreneur of the Year event. David's co-founder of EPR Properties in Kansas City in 1997 with little more than a computer and 2 telephones and a few sublet cubicles. The company is a specialty real estate investment fund that builds and leases entertainment, recreation, and education properties traditionally that were thought to be too volatile for institutional investment. By 2015, EPR Properties had built an investment portfolio of $4.5 billion with more than 240 properties across 39 states, investing in theaters, retail centers, water parks, ski parks, public charter schools, and more. Upon its induction to the Entrepreneur Hall of Fame, David provided the following advice to aspiring entrepreneurs via a video message. He said, "Don't succumb or be deluded by the myth that entrepreneurship is about working for yourself. It's not. It starts first with the needs of others." Ladies and gentlemen, please help me welcome Mr. David Brain.
Whoa. Thank you very much, Jeff. Thank you all, Rainier Institute, Bloch School. And I mean, not only for tonight, for the whole Hall of Fame thing. I got to tell you, it's quite an honor. It's really quite a category and association, like with Henry Bloch and the school here. It's kind of daunting, and then to think about being in the hall and kicking off this series and so forth. I was always just trying to put one thing in front of the other, and it worked out. So I was wondering exactly, because I have talked in some of the classes, and I have talked about some business planning aspects. And I did a venture lounge with the Enterprise Center in Johnson County presentation in this room a little while ago. Hopefully not too many were here because I'll use some of the same material. But there I talked a little about EPR, and I also talked about the road forward with a new idea. But I saw the advanced materials, and I saw they were focused on EPR properties. And this is our original logo going back to 1997. So what was originally Entertainment Properties Trust. So I'm gonna focus on that. Tell the tale a little bit of the the dark and stormy night when it all came together and how it worked out. And in the way, I'll not only try and relate some of that. I've probably got a ton of details I won't torture you with, but I'll also try and relate it to some business planning fundamentals that may be more applicable for you all, for what you're thinking about and things you're engaged and focused on. But this was our original logo back in the late 90s. You can notice there's a big difference between the kind of, that's not very, the clean image of today versus the original late 90s. We actually were starting off, we picked the Coliseum because we were trying to say something, and this will be part of the theme of what I think is important to take away from here. We were trying to tell people a story very succinctly, very quickly. And we always try to endeavor to do that. I think it's very important. Don't be long-winded, and that's a lesson to myself tonight too. But to try and the image of the Coliseum was all about two things. Remember, the name was Entertainment Properties Trust. It was about congregate entertainment, people coming together for a shared experience. Very important in a digital and fractured age where people are doing a lot on a solo basis. That was even true in the late 90s. And we were trying to say something about its durability. And the line we used to use was, this has been part of the fabric of civilization for thousands of years. If you think that's going to change, I can leave now. And we'd start that with some of the institutional investors we talked to on the original Roadshow. We were trying to make the point because people would challenge us with, this was not a technology deal, well, in a way maybe, but it actually was an anti-technology deal. It's still in the late 90s, there was the emergence, there was still the third generation of capturing movies at home that went from, VHS to DVD, and it was going to direct broadcast. But we were talking about a shared experience, and Entertainment Properties Trust originally was all about this. And that's a movie theater. It's a very big movie theater. It's a 100,000 square foot, 30-screen movie theater. And the dawn of this generation was in the late 90s, actually the first one built in 1995. And the whole story of Entertainment Properties Trust, which later became EPR Properties, and I'll try and explain why we went through that name change and rebranding. But this all started with a fellow by the name of Stan Durwood. Anybody know that name? It's your ball fields? Yeah, so Stan Durwood was the innovator of this. And Stan Durwood and the Durwood Theaters had once existed as the Durwood Theater Company in movie theaters back in the 50s, when Stan joined the family company and built the Ward Parkway Twin Theater, which was the first multi-screen movie theater in the United States, in Kansas City, and he renamed the company American Multi-Cinema, AMC. So Stan had an insight in the 60s that changed the industry. Stan had an insight in the 90s that changed the industry. And this was the second, really, we called it Stan's second epiphany, but it was really, he said, let's build a movie theater rather than showing some of the movies. Let's show all the movies that are in the market and have a destination property. It was really, yes, no. Okay. There we go. Okay. So the Megaplex Theater was really a destination property. It was really the third generation. The movie theater had gone through two prior generations, one called the Downtown Palace. It was really the grand theaters. You still see remnants of them in terms of things like the Midland Theater in Kansas City, which was originally a movie theater, not a performance theater. But the Palace Theaters were created, and then later they gave way to, they ran about a 30-year from the 30s into the 60s. In the 60s, they gave way to the multiplex with the Malling of America. But now, all of a sudden, Stan's idea was you create a superstore. You create a superstore with 14 or more screens. Basically, there was math built on the release calendar and population, but it was anywhere from 14 to 30 screens. The one I showed you was 30, but it was the big difference here is in selection and convenience. Because going to the movies was like solving a riddle. It was trying to figure out in those days before you had information on demand with your smartphones. It was looking in the newspaper, figuring out what was showing where and when. And Stan said, let's take solving a riddle out of the equation. Let's build one giant store And this was very revolutionary. And then additionally, he overlaid the concept of delivering high selection at a single location with stadium seating, state-of-the-art audio, video, and really expanded lobby and theming. And so this property, and by the way, I'll get to a little bit, but I do come from the real estate side of the spectrum, so you'll notice that this is about the creation of a real estate investment trust, or a REIT, an REIT. And a real estate investment trust is nothing more than a fancy name for an investment fund that invests in real estate properties. But so these properties stand, so these were shots. These were actually shots we used in our IPO deck. So this is for properties that were from, 95, 96, 97. And this was unlike anything the market had ever seen before. And it was very revolutionary. There'd never been stadium seating. Slope floor was the standard because slope floors were built to fit in shopping malls where multiplexes were part of shopping mall development from the 60s into the early 90s. These were standalone properties that commanded their own locations. Well, now it's jumping ahead of me. Spooled up. So here we go. See how far it goes. There we go. So we're back to the total differences. So we took this saying, and remember I said in the beginning we tried to tell stories succinctly. So we used to tell people, we showed them the giant picture of the movie theater, and then we told them it's a convenience store, which completely set people's thinking on end. But it was great because we jarred them into thinking about what we were telling them. And a convenience store was a way to frame all the advantages we were creating through this real estate development. And that is high selection at a single location is the essence of convenience. Convenience is defined as getting what you want when you want it. So if you do that through a larger store, that's still a convenience store. So it was on this concept. Stan had generated the idea. Stan through AMC, I happened to be a lowly investment banker at a local firm, George K. Baum and Company, and was in contact in what's called coverage with AMC. And because of the revolutionary nature of this development, its scale, its size, its lack of precedent in the market, they could not find funding for this, and they were funding it off their own balance sheet. Real estate development like this for a retailer is not a long-term proposition. You can do it for a while, but you can't solve that. You can't do that properly long-term, particularly with the scale of rollout they wanted to do. So I got the opportunity to help them create a funding vehicle, and I was the first guy really to quit my day job to try and put the package together. The company was super supportive of me. I got a 6-month consulting agreement. I had 3 children under 4 years old. My lovely wife here was bared up under all of this, where we quit and had no health insurance and so forth. But it seemed like a really great idea because it was so compelling, and the first few units opened were so successful. So on the strength of this idea, we executed a Denovo IPO. You know what I'm saying? I mean, I had $20,000 invested when we listed to go public. That's all we had. We had literally that story. I had 4 sublet cubicles from a law firm, 2 phone lines, an answering machine, and borrowed office furniture. And we raised $275 million. Now, here's where we're going to get into the detail. How does that happen? Well, first of all, it happens with a lot of wind at your back because real estate was very hot right then in the late 90s. This is before we went into the tech bubble of the very late 90s. So this is 97, 98. People were making a lot of money on real estate in the mid and late 90s because they bought real estate in the late 80s and early 90s during the time of the S&L crisis. the financial institution crisis where institutions were shedding real estate for pennies on the dollar, and people now were ringing up extraordinary profits. And some people didn't want to divest of all their profits, so they took their portfolios and listed them publicly. But there was like a feeding frenzy that you sometimes find like in tech. At that time, it was going on in real estate. So people were anxious to get on the train with real estate ideas because everybody was making a lot of money. So that's a really good time to go into the water, is when it's flowing heavily in your direction. But it was more than just an idea. And the one thing I wanted to say, our company focus, our mantra, our mission, our definition of ourselves, what we used to say to ourselves is EPR purchases high-quality properties and turn leased to entertainment and entertainment-related businesses. Well, how boring is that? I mean, that didn't tell you a lot. But we had that, but we also had more than that. And oh, by the way, you know, my career there over 20 years, we went through a number of different brands and marks. So I've got all kinds of slide backgrounds, and I apologize, but I stole from different presentations to kind of piece this thing together. So this is a later generation and a different logo down in the corner. So, but we had an idea. Okay, that was about leisure property. And to date, there'd never been a leisure investment fund. There'd been apartments, residential, there's office, there's retail, there's industrial, but there'd never been an investment fund, listed investment fund related to real estate and leisure. And so that was the idea, but we couldn't raise money just on that idea. It's a great idea, but we had to put focus to that. The focus was the Megaplex Theater. We specifically had a horse to ride. And that was the development and the deployment of the Megaplex Theater that basically was going to reinvent the industry. But beyond that, that still was not enough to raise money against. You had to have a basis for people that are going to make investments of a substantial level. They're going to want more than an idea, and they're going to want more than a focus. They're going to want to begin to do diligence on something. If they don't, they feel like they haven't done enough work and they can't write checks. So we had AMC, and AMC has a performance track record, and they could go through a lot on that, and they were going to be the operator. But even beyond that, they really want grounds for financial analysis. Okay, AMC's a great operator, it's a great idea, it's a great concept, I see some that are open, but we had to negotiate specific lease terms in order to give people an ability to make basically, financial projections and analysis of returns. This is something I sometimes lost when I've come and talked to some of the classes and been on some of the judging the plans, and people have an idea, or maybe they have some focus to the idea, and maybe even that idea then connects even with some user, but you got to get it, you got to take this thing down the road as much as possible to get it grounded as much as possible through really financial analysis that people have a lot of comfort in. And when you get that done and you start making your pitch deck financially, now I'm going to segue into some things I usually do in some of the class. I say, I have a takeoff on what you need to focus on, and there are what's called 3 C's of lending. I don't know, has anybody heard of these? If you're in the banking world, if you come from the financial banking world, you hear about the 3 C's of lending of credit, collateral, and character. Well, it's different in the equity world. The 3 C's of equity investing start with concept. They also have to do with competency and capability. And then they have to do with your capital plan and return on and return of capital. Now, what's so different about these? Why are they so different? Why is an equity pitch so different from a debt pitch? A debt guy only has one surprise, and that's to the downside. He's going to get a stated interest rate in his money back, or he's got problems. So he's going to focus on warding off those problems, and that really has to do with those 3 C's of lending. An equity investor is not worried as much about the downside, they're looking for the upside. So they want to be focused on this concept, competency, and capital. And to drill down a little bit on those, in concept I usually tell people, again, start with comparables if you can find, even if they're in different industries, even if they're in different categories, if you can make some allegory, if you can make some connection with a previous success record of reinventing, in our case, reinventing a retail category. It could be supermarkets replacing grocery stores, home center stores replacing hardware stores. then you make that connection as well as possible. And competition-wise, you want to look at the economics of the existing, your competition, but also the potential, your economics, and what could replace you. Under competency or capability, you want to focus on control of inputs, control of critical success factors. Those are usually inputs, customers, pricing, a lot of those things. Control factors, and in this case, it actually happened to be film deployment, so AMC covered that, and then, these are all C's, and then I lose my C's with this damn expertise and experience. If somebody could give me a C, because I just like to do all C's, but I haven't figured that out. But anyway, you have to be able to check that box with people, and prior experience of navigating the waters and launching companies is always helpful, or anything similar to that. And then on capital, I think the first thing you always have to address with investors is what I call co-investment or commitment. Investors have to know that you're all in. You have to go first, and you have to be committed. And that way you can draw in potentially the treasure of others. And then structure, and how's that stacked up, and who comes first, and we could talk about structure a lot, but that'd take enough time in itself. So to revert back to the EPR story, this was really what happened in November of '97. We end up with a Denovo equity offering of about $275 million. We handsomely paid all our advisors and ended up with about $255 net. We ended up, based on that, we were able to get a syndicated loan agreement. Again, one of the reasons we were able to do this is the specifics we had with regard to our rollout program and the lease terms, and we had a whole program of investment laid out. And so then we raised $400 million in a bank debt offering, ultimately then did our first bond or collateralized mortgage bond security, independent financing in '98. And in '99, we did our first secondary offering, which you're only able to do if you start actually performing on the business plan. But this then became, this is an interesting graph, and people think, well, oh my God, you raised $500 million, poof, off to the races. Well, not so fast. So we had the first 2 years where we drew down the equity line, and then we drew down the debt line, and we were doing a couple $100 million of investment, building out these theaters, leasing to AMC. But then you can see all of a sudden we got stuck in the mud, and this was the tech bubble. This was the first round of tech bubble in the late 90s. Nobody gave a damn about real estate, and so nobody would devote any capital to it. So our stock price went from $20, $22, our IPO listing was $20, we went to $10. We went down by more than 50%, even though our portfolio was performing fabulously. Think today, energy companies. Energy pricing is off, and there are people, investors and lessors, leasing companies in the energy world that are doing quite fine, that are being traded at 50% of value because everybody is off the energy trade right now. So these kind of momentum plays, this is the opposite of the momentum play I talked to you about. And then finally, we got some traction again in the mid part of the graph in 2000. And essentially what happened in 05 and 06 is we started running out of, we had built, we built a couple $1 billion worth of theaters, and we were running out of places to put these new 33-inch theaters because you can't put them everywhere. So we started to diversify, and I'll go to that in a minute, and that's really what jump-started the company again. And then if you go past this graph, it's pretty steady at $400 or $500 million a year up until today. And this is one of my favorites. And this is that depiction of that bar graph you just saw of EPR's growth. Everybody thinks, well, wow, it's just a rocket. No. This is the reality and what you have to prepare for. And going back to commitment and character, this is why investors are so concerned about this, because this will happen. It will turn into a scramble at some point. And you have to have people prepared for not only the original execution, for come what may. Well, the company history then turned into this nice, beautiful graph. See that annual graph you saw? Can I do this easily? This annual graph, which is kind of checkered, turns into this on a cumulative basis that looks lovely. It does look like that straight line, right? So people show you this when actually the reality is the other I just showed you. But you could see it did plateau. We came out of the chute and got up to $500 million in assets, and then we plateaued for a while, and then we started growing. It was all Blue Bar. Blue Bar was movie theaters. We were all movie theaters all the time. And then, as I said, we started running out of movie theaters. So you can see in 2007 and so forth, there start to be some other colors that appear on the screen. And this is what Jeff said at the beginning. We've done investments in ski properties and in water parks. Again, these are all leisure-type properties. And then ultimately, we created, lastly, an investment category of schools, education. Again, this is not a common institutional investment to invest in elementary schools. It's usually they're done through bonds and they're not done through direct ownership. So this is just an illustration of one of the schools we built. We built almost $1 billion of those. Ski hills, this is the biggest ski hill we own. We tended not to own Telluride and Aspen, but we tend to own things like Mount Snow here in Kansas City and Mad River in Ohio. But you know, they're good ski hills. This one happens to be in Vermont, but it's one of the lesser in Vermont. And the company turned into this kind of profile of really running ultimately 3 divisions of entertainment, education, and then we broke leisure into entertainment and recreation. Really, entertainment being things that are more passive and the recreation being more active pursuits. We still, to this day, I got to tell you, we've built the portfolio's up to $5 billion, and let's see, I got a track record. Well, I first have to tell you about our identity crisis. So we were theater guys. As I said, we motored along for about 6 or 8 years doing only theater investments, and then all of a sudden we started changing gears and doing other things. And this is, again, one of the things you have to deal with. There will be evolution of a business. And so we were theater guys, and then we became school guys, and then we became ski guys, and so the question became really, who are these people? And we came upon a point in time, this again is in the second logo period, where we changed from the old Coliseum shot, which was a free domain shot of the actual Coliseum, to kind of a modified art version of it. We ended up identifying ourselves this way as an entertainment properties trust is a specialty real estate investment trust, again a REIT. We invest in select categories requiring unique knowledge with potential for stable and attractive returns. It doesn't say anything about, except in the name of the company, entertainment, and later we changed that. And that's why we shed the word entertainment, because we started doing a lot of education and became just EPR Properties, which was our ticker symbol. We laid on this kind of communication, again, trying to succinctly tell people that we were specialty in select areas based on unique industry knowledge. Everything we did, a lot of people did not, people don't understand movie theaters. How the hell do they make any money? You know, and is it all in the concessions, or still pretty cheap to go? And I think it's cheap to go. And so too ski hills, and so too schools. These are very unusual industries. And we began to portray ourselves as the guys in the middle between traditional REITs. There are some REITs that are super specialized in single property types, and then there are some diversified funds, highly diversified funds, and we were the guy in the middle. We were focused, but we were multi-category investors. This was also an articulation, and again, I show you these slides, not so much there will be a quiz later, but not so much to communicate about EPR, but just to say it's important to get people across graphically, quickly, impactfully, as well as you can, those things that they can get their mind oriented about where you're going. And this is a slide we used in different terms, but it's kind of a later generation, but it was always kind of part of what we talk to people about, again, we're long-term investors, knowledge-driven in few categories, again, these select categories. But we also developed what we call this 5-star investment criteria. We did that because after we did a few new things, some of the institutional investors were afraid, I'm not sure what these guys will do next. So we try to say, well, we'll do what comes next if it meets these criteria. And my favorite one is the last one, the advantageous position. It basically means we'll do something if we can get an unfair competitive advantage, which is what we were always looking for. And usually that's a first mover advantage. So just to tell you about the financials of the company and how it launched, this is the long-term graph. We went over a little bit of the initial capitalization, but this is my, busting buttons proud graph of how we kicked all the peers. You got to remember, well, you don't remember. I want you to understand the properties we were investing in, movie theaters, ski hills, water parks, charter schools, people thought, and they generally are rated as not junk, but trash credits. I don't know if you know, basically, I can go through the whole rating, but essentially A credits down through triple B will be investment grade. In the Bs, you'll be in junk land, but you get into the Cs, it's trash credit. And almost all of our stuff was trash credit. And yet, with that, we were able to put together an 18.5% compound rate of return. And what is that, a 1,200% return over the life, up until, that's actually, I cut the graph off when I stepped down as CEO, which was just about 3 quarters ago. And what was really important to me also is we did not do our debut bond issue. I mentioned we did a CMBS issuance, but we did not do a sole issuer bond issue until 2010. And we were able to get with trash credits, with true junk credits, and people felt like non-institutional grade real estate. We were able to aggregate that together and get 2 out of 3 rating agencies on our debut bond to rate us investment grade, triple B, Baa3 for Moody's, triple B minus for Fitch. Standard & Poor's would not give us, but then they finally today we're investment grade rated, and we've been upgraded by all agencies. So this is really a story of cast-offs to cornerstones. It's a way to make, in the aggregate, you can make value out of poor credit on an aggregation play. And I often described, again, being succinct, the company this way. We were always the guys willing to take something that looked like a square peg into a round hole and make it work. We weren't guys that tried to have everything served up to us on a silver platter and with fitted credit and everything else. We would take junk deals and make them work, and ultimately make them work in the aggregate into an outperforming portfolio that's investment grade rated by all the major credit rating agencies. Well, so this is one of my sayings at the end I thought I'd share with you. I don't know if you ever heard this quote from George Bernard Shaw. The reasonable man adapts himself to the world. The unreasonable man persists in trying to adapt the world to himself. Therefore, all progress depends on the unreasonable man. But I think that's one of the definitional quotes I have for the entrepreneur. It's not deja vu, it's vujade. Vujade is seeing the same thing in a different way. So from here, the 90s, through that stage, our second generation, to the later stage credit is really the story of EPR. And the launch was all about seeing what wasn't there, but what could be, and the articulation of that plan with as much specifics to allow the financial world to embrace it and to support it. And it's worked out fairly well. When I did the Venture Lounge talk, I'll just do a little prologue with you. I stepped away as CEO of EPR after 18 years, about 3 quarters ago, and have a few new ventures, but a primary one going I talked about in my last appearance here. It's nearby at 39th and Gillum, the Westport Middle School, which is under construction now. And you may have seen, we were just on Fox 4 News about it, but it's converting an old middle school public school. We'll be converting that into a co-working space. And we'll be flagging that with a leading operator in the co-working space world here in the market, PlexPod, that's in Lenexa, Kansas. And this, I think, is about another new generation. Again, going back to one of the categories of real estate office has generally been an unbranded category. Can you name me a brand of office buildings? What? But this is real. I think in the future, office buildings will basically be flagged like hotels, more so. It's less of a building part of an operator, but it is. It's one of the few branded multi-location office operators. It's still operating, I believe, in a model, what I call a siloed model, where basically if you lease an office there and I lease an office there, I might see you in the hallway on the way in and out or something like that, but there's no sense of building community or any kind of connection. And the office buildings of the future, what we've been created, the Westport Commons at 39th and Gillum, will be an office building that'll have about 30% of its space will be common space to be used by people. It'll be from conference rooms to just meet-up areas to lounge areas to recreation areas, and people will want to be a part of that, and people will have a greater sense of a community than even the company they work for. And I think you'll see the evolution of this, and so hopefully we'll be creating a new brand, and you'll see it as commonly as you see like a Hilton or a Marriott hotel down the road. So I think that's it. I have no idea how I'm doing on time. That's what I've got, and maybe we can go to questions, and I'll try and do what I can.
All right, thank you, David. So we'll go to questions. Is this thing working? Can you guys hear me in the back? Yeah? Okay. So we'll go to questions. As I'm making my way over the first question here, let me kick it off. Your artifact in the Entrepreneur Hall of Fame and the video for our Entrepreneur Hall of Fame has a lot to do with going public. And if I read between the lines in your video, you have some mixed feelings about that process. Can you talk a little bit about how that went? You mentioned it a little bit, but
Yeah, so the company was, as I say, a Denovo IPO. It really had no, I incorporated in August of 97, and we went public in November of 97, so just months later. And really the whole business plan was if we could raise significant capital, but we had to raise large amounts of capital quickly, because our client that we could put this money to work for on the terms, as I said, the pre-negotiated terms, everything, AMC Theaters, which was our first primary client, we had to be able to raise lots of money very quickly, and so that was our first shot at doing that, and it felt like the market was very hot, as I indicated earlier. So, but going public it's gotten way more complicated since things like, Enron and Sarbanes-Oxley, and it continues to get more complicated. It's also very complicated. When I left EPR Properties, we were managing about $5 billion, and we had 38 employees. So it's hard to run a public company with all the compliance requirements with a small shop like that. Most public company regulations are built for large headcounts. And so it was a little bit, it suited us very well for our original business objectives, but less so as time went on. And again, the market falls in and out of love with ideas. They're in love with energy and they're not. And they're in love with technology and they're not. And then they're in love with real estate and then they're not. And so sometimes when they're not, it's a good time to go private. But.
all right, we got our first question here.
You listed knowledge as one of your key competitive advantages. How do you take something as ephemeral as knowledge and make it enduring? I mean, is it people? Is it an artifact? Is it intellectual property?
Wait, you're going to have to help me here with this question. So how do I take something that, like an intellectual property, make it yeah. Yeah. Well, there is kind of a little bit, I got to tell you, in art that's been all through the company, is you try and make it sound like, in one regard, you try and make your business sound terribly simple. But particularly when you're in the public company realm, and let's say we're in an investor forum. I could be in a room with investors like this, and I could have 5 or 6 potential competitors in the room with me. At the same time, I'm going to try and make it sound simple. I'm going to try and make it sound complicated, like no one else could really ever do what we're doing. And there's a little bit of an art to that. A little bit of a, I can take you so far, and then I can't take you past the curtain, because behind the curtain we have all of our secrets. But I think one of the ways you make an idea durable is, as I said before, is first take your concept and first you got to build it into what I call comparable, so other people can quickly get to the idea and see the world the same way you do. That we were going to basically create what home center stores were to hardware stores, we're going to do to movie theaters. Okay, I can fairly quickly get on the page with you for where we're going. And then at the next time you try and also get that down, grounded in as much detailed economics with lease terms and financial projections, and because capital raising is what part makes that durable. I guess that's the best way I know to answer that. That's my answer for how we did that.
I mean, you can just say you're just smarter than us.
Hi, David.
Hi.
Is this on? Okay. You mentioned something at the beginning, if I heard you right, about an investment roadshow. Could you expand on that a little bit? What led you to take that direction and what you got out of it?
The roadshow? Yeah, maybe I didn't mention the roadshow. Well, you know, an IPO, the whole process of doing that is you have to take your idea and you have to vet it with investment bankers. And I was used to doing that because I was on the investment banking side, albeit I was not a Wall Street-sized firm at George K. Baum. But I'd seen pitch decks before. And so you got to get that together with some of the things I was reflecting. And you get a couple investment bankers that are willing to take you around to the accounts that they traditionally call on. And that's essentially what's called a roadshow. And we went on the road. I went all the way from, I went to Hamburg, Germany. I did a number of stops in Europe. I did luncheons in London, and then 3 weeks in the United States. And during all that time, the bankers are always trying to take indications of interest, and then ultimately they'll go back and try and what's called close the books on the deal and take orders. But the more complicated, the more unprecedented, the more unusual the offering, the longer that will take, and it took us quite a while. Typically, roadshows take a week to 10 days. We took 3 weeks plus of going around seeing people, and you end up telling your story, 8 to 10 times a day for days and days on end until you hate yourself. You hate the whole thing. You're like, oh my God, I'm so sick of this. But anyway, you stay with it. But that's how that process works.
All right, thank you. We got one right here.
David, thanks for coming and sharing this and having us all learn something. This is really an industry question. We have our own kids and around a lot of young people. They seem to spend a huge amount of time on these illegal movie sites.
Yeah.
Right?
Yeah.
We watch Netflix and Hulu and Amazon and stuff.
Right.
Still go occasionally to the regular theatre. But how hasn't all of that stuff affected AMC?
Yeah, here's an interesting thing. I usually show a graph of this. The beautiful thing about box office is it does look like that straight line graph. It's a thing of beauty. And when we went on our roadshow, and I used to follow up with some investors, 5, 10, 15 years later, and if you showed people a 5-year, 10-year, 15, 20-year, 30-year series, whatever, it always looks the same. Box office tends to grow 2 to 4% a year. Last year it grew 5%. It really got a kick in the pants going forward because of Star Wars. Sometimes you'll see as much as a 2% dip, but that's all you've ever seen. Those are the biggest dips you've ever seen in the last 35 years or so. Part of it is going back to my slide, it's part congregate entertainment is part of the fabric of civilization for thousands of years. The fact is, people don't want to stay home. There's an old joke in Hollywood. It says, every house has a kitchen, and people still go out to eat. That's the old saw in Hollywood. Let's not fear home consumption. Home consumption is fine. We'll always get our share because people want to go out. My son, when he picked up his date, did not want to bring her back to the house to watch the movie. I don't know why, but he didn't. So they wanted to go somewhere. Where can you go for $10 a person for a $100 million production value for 2 hours? You certainly can't go to a ball game, can't go to a live theater, can't go to a concert, can't do any of those things. This is still one of the access points for high quality congregate entertainment. And the fact is, here's the interesting fact, and it's been studied a lot by Hollywood, and I won't torture it, but the more people watch movies at home, the more they go to the movies when they go out. There's a positive correlation. What happens is if you watch movies a lot at home, you become a videophile. You now know the Coen brothers with Hail Caesar. You think, oh my God, I've seen all of the Coen brothers movies. I've got to go see this. And so you go. Or you see, it's a Matt Damon. It can be around genres. It can be around series. It can be around produced directors. But people who get more immersed into it, and the expanding the consumption channels has actually just helped Hollywood and helped the movie theaters. It's counterintuitive, but if you stop and think about it, it makes sense.
All right, other questions?
Too long of answers to short questions, I think.
I just have one question just about, David, did you have someone, I think I might know who it is, but did you have someone who was an important mentor to you, and what do you feel like the importance is to have a mentor as you continue down this pathway?
Oh, most definitely. I have to say Stan Durwood, but I really, there were mentors outside of that. I'll mention one, nobody will know, but a guy named Bob Lindner. Bob Lindner was a mentor of mine. I was at KPMG, toiling away. I was in the consulting group and I was doing kind of financial projections and all kinds. I was doing business plans for people before I went in the investment banking group. And Bob was always a guy about, simplicity and succinctness, and used to have a saying about if it's simple doesn't mean it's unsophisticated. Very often people think things have to be complicated to be sophisticated. Not true. A concept can be groundbreaking, and it can be as simple as, building a 30-screen movie theater rather than 4 8-screen theaters by putting high selection, single location. So it's just thinking anew. So, but very important.
We've got one in the back while I head up there. We've got a lot of young entrepreneurs here. One of the things we focus on in the Rainier Institute is making sure that we find opportunities first before then building the business later. How would you, or what advice could you give young entrepreneurs on finding the next good opportunity?
Well, you kind of start with that. I was going to answer that when you talked about what's out in the hall in terms of my quote in the film about, you don't work for yourself, you work for others, and the first thing is answering needs. And I think that's it. I think the best thing to do is look for something people hate to do, hard to do, pain in the ass. You want to make things simpler, easier. That's exactly Stan's idea of creating the high selection location movie theater, and then ultimately my ability to then facilitate his insight by creating a better access to capital. And so he didn't have to go out and finance each individual property. He could have a financial partner that was there, and he could roll out, basically the whole thing together. If you solve problems for people, that's essentially it. I would study larger organizations. You could take a Garmin, and what's their biggest problem, and see if you can solve that for them. Or when I did the Venture Lounge, if any of you were here, I showed a picture of Rhett Butler from Gone with the Wind, because one of my favorite lines is Rhett Butler about fortunes are made when kingdoms are being created or torn apart. And it's true, whenever you see massive change going on, there will be creation of need. And very often, larger organizations don't want to staff up, internalize for all that need. And if you can identify that and solve that, you'll create an opportunity for yourself. And it's great to play off a larger organization like that, because although AMC was only a double C credit, they were kind of crap. They were still a big organization, and they credentialed, our enterprise, because we were then going to lease to somebody who people had heard of.
All right, thank you. And I think we've got time for this one last question.
Hi, first I want to thank you and all the other folks who serve as eScholar mentors, because it's really a huge deal to have you sit in a room and critique our ideas.
Well, I got to tell you, I love coming. Sometimes I don't make it all, but it's very energizing for us too, to hear about new ideas, and it's a way to see the world through new eyes. It's great.
Well, thank you. My question is, when things weren't going as you expected and you had given up your paying job to jump into this, and you kept working on it no matter what was, when you were the most discouraged, who or what was the kindest thing that happened that kind of kept you moving?
Oh, gosh. Well, I got to tell you, I showed you that graphic, and I didn't, I don't know. The stock graph almost doesn't do it justice the way we came out of the IPO and went down. We had this real valley of death 12 months after we launched the company. Everything was going gangbusters, and all of a sudden the stock price just began to crater. And it was, and we stayed down. We stayed below our IPO price for 2 years. It was horribly discouraging, and that's why the portfolio flatlined. We couldn't raise any money. Everybody loved us for a while, and then the wind changed. I don't know. I think the most rewarding thing was just the direct relation we had with all of our clients, and I guess the team and the company, of knowing we were honoring our promises. It was very satisfying for me at those times to still go out to, and if you're in the public realm, you do a lot of investor forums, you had to go to a lot of events, and it was still be able to tell people, hey, I know the stock price sucks, but God damn it, we did everything we said we were going to do. We got the money invested, the yields work, we have no defaults, we're collecting the rents, we're paying the dividends, our coverage, everything's great. It's just unappreciated. And I guess we were kind of in that together. And our clients and our team, which in those days was about 10 of us. So that was, they had that kind of camaraderie, I think, was the thing that was sustaining.
David, thank you so much for joining us today.
Thank you.